If you are an investor watching the Straits Times Index today, you probably saw the headline and felt a massive wave of boredom. The market moved a tiny, almost invisible 0.15%. You look at your screen, you see the red and green flickering, and you think, is the Singapore market dead? Is this stagnation the new normal? When you see numbers this flat, the fear isn't a crash. The fear is irrelevance. The fear is that your money is sitting there doing absolutely nothing while the rest of the world moves on. But if you strip away the boring headline number, if you ignore that flat 0.15% on the surface, the real story is bubbling violently underneath. This wasn't a day of stagnation. This was a day of strategic positioning. This is the calm before the storm. We are seeing massive institutional money moving into our local banks, a complete structural shift in cross-border retail for Capitaland, and a shipping counter that just exploded with a fourfold profit jump. The market isn't sleeping. It is holding its breath. And if you aren't paying attention to what happens next, you are going to miss the exhale. I'm Iggy, your Singapore-based market analyst, and my job is to cut through the noise, ignore the clickbait, and show you what really matters for your CPF, SRS, and SGX portfolios. And we have been putting in the work. Since October 2025, this channel has produced over 1,200 videos with more than 600,000 watch hours. We were also honored to be ranked 8th in Tiger Broker's 2024 Influential Tigers. My focus is always on regional and global trends to give you that broader context so you can uncover hidden gems and potential pitfalls. Today, we are going to do exactly that with a deep dive, slide by slide, through the hidden movements of the Singapore market on December 2nd, 2025. Let's get right into the methodical breakdown. First, let's look at the broad market overview, specifically the Straits Times Index, or STI. The STI closed up 0.15%. Now, to the untrained eye, this looks like a non-event. But let's define what is actually happening here. This is what we call low volume consolidation. Investors are cautiously optimistic, but they are clearly keeping their powder dry. Why? Because of the 800-pound gorilla in the room, the US Federal Reserve. We are days away from a critical interest rate decision. You need to understand the mechanics here. When the Fed moves rates, it dictates the cost of capital globally. For a REIT-heavy, dividend-focused market like Singapore, the Fed's decision is everything. If they cut, our REITs fly. If they hold or hike, the pressure remains. So that 0.15% gain isn't laziness, it is discipline. The market is refusing to make a bet until it sees the cards. For us as Singapore investors, this is exactly what you want to see. You don't want erratic volatility. You want a market that respects the macro data. Now let's move to the next slide and talk about the heavyweights. This is the most critical part of today's update, the banks, specifically DBS and OCBC. If you hold the STI ETF or if you hold these banks directly, today was a very good day for your conviction. We saw a major vote of confidence from JPMorgan. They upgraded both banks, forecasting strong dividend payouts and potential new highs for their stock prices. Let's analyze why this matters. Why is a foreign bank like JPMorgan bullish on Singapore banks in late 2025? It comes down to two things: net interest margins, or NIM, and dividend sustainability. There has been a fear that as global rates peak, the bank's margins would crash. JPMorgan is effectively saying, no, the earnings floor is higher than you think. They are looking at the balance sheets and seeing a fortress. From my perspective, Iggy's take is this: the market is telling you that our local banks are solid as a rock. I have said this time and time again on this channel. Singapore banks are not growth tech stocks. They are dividend compounding machines. For long-term dividend investors, this upgrade is a clear signal to hold. You do not sell a winning horse just because it takes a breather. And for those on the sidelines, it might be time to start a position. The key here is the dividend forecast. In an uncertain world, and 2025 has been full of uncertainty, strong, reliable dividends are king. This isn't just short-term noise, it's a fundamental belief from a major institution that our banks will continue to perform and reward shareholders. When the big boys tell you the cash flow is safe, you listen. Let's switch gears to the property sector. I want to pull up the chart for Capitaland Investment, or CLI. CLI saw its shares rally today, and the catalyst is fascinating. It's not about interest rates, and it's not about rental reversions. It is about infrastructure. The news is that their new mall in Johor is set to be linked directly to the Singapore-Johor Bahru Rapid Transit System, the RTS. Let's define the opportunity here. The RTS is a game changer. We are talking about a massive funnel of foot traffic moving straight from Singapore to Johor. By linking the mall directly to the transit line, CLI essentially guarantees footfall. In retail real estate, location is everything, but connectivity is the holy grail. Let's analyze the strategy. CLI is moving towards an asset-light model, managing capital rather than just hoarding buildings. This Johor project is a perfect example of capturing regional growth. The Singapore-Johor Special Economic Zone narrative is heating up, and CLI is positioning itself right at the front door. Here is Iggy's perspective on this. This is a brilliant long-term infrastructure play. The success of a mall is all about location and traffic, and CLI just secured a golden ticket. This significantly de-risks the project. If you are worried about the glut of malls in Malaysia, this connectivity acts as a moat. However, we have to be realistic about price action. The price has already moved on this news. The algorithm, bots, and the quick traders have already eaten the initial meat of the bone. So I wouldn't recommend chasing it tomorrow at the opening bell, but add it to your watch list. This news makes CLI a more compelling long-term hold. This is the kind of structural advantage that pays off over 5 to 10 years, not 5 to 10 minutes. Any market dips could be a great entry point to ride the RTS growth story. Now let's move to the wildest chart of the day. We need to talk about Marco Polo Marine. If the banks are the steady tortoise, Marco Polo Marine is the hare that just drank 3 Red Bulls. They posted a stunning turnaround. Their half-year profit jumped fourfold to nearly $48 million. Let's define what is happening here. This is the shipping cycle. Shipping is notoriously cyclical. It goes from boom to bust and back again. Marco Polo Marine operates in the offshore support vessel space and increasingly in the renewable energy sector supporting wind farms. A fourfold increase in profit signals that charter rates are up and utilization is high. The supply of ships is tight and demand is roaring back. Let's analyze the numbers. As $48 million is not a small jump. It is a structural change in their earnings capability. It signals a major improvement in the struggling shipping sector. The operating leverage here is massive. Once your fixed costs for the ships are covered, every extra dollar of revenue falls straight to the bottom line. That is how you get a Forex profit jump. Iggy stake? Wow. This is what a cyclical recovery looks like. But I need to issue a warning here. For investors with a higher risk appetite, this is a fascinating story. The company's financials are suddenly looking very healthy. This could be a momentum trade for short-term players who know how to read technical charts. But for longer-term investors, you need to ask one question: sustainability. Is this a one-off spike or is this the new baseline? The big question is whether they will start paying dividends again. If they reinstate a dividend, the stock will re-rate significantly higher. Right now, this is a speculative buy, but the numbers don't lie. The turnaround is real, and it suggests the entire shipping sector might be finding its sea legs again. So we've looked at the macro STI, the banks, the property play, and the shipping recovery. Let's pull it all together in Iggy's assessment. First, let's talk about what's working. The Singapore Inc. core is working. The banks are generating cash and they are being recognized for it. Infrastructure-linked plays like CLI are finding ways to grow despite the high interest rate environment. And we are seeing deep value unlocking in cyclical sectors like shipping. If you are a stock picker, this is a great market. There are winners if you look under the hood. Now, what's not working? Broad market sentiment is still weak. Volume is low. The general public is still scared, sitting in fixed deposits or T-bills, refusing to enter the equity market. This lack of liquidity means that good news doesn't always result in a sustained rally immediately. The market is fragile and reactive to the US Fed. Regarding valuation, the STI is currently trading at a very attractive valuation compared to historical averages. We are looking at a dividend yield for the index that beats almost any other developed market. You're getting paid to wait. The price-to-book ratios on the banks are fair, and for many REITs, they are still trading at a discount to book value. So here is the final recommendation for existing unit holders and shareholders. If you own DBS, OCBC or CLI, you hold. The thesis is intact. In fact, it's stronger today than it was yesterday. The yield is decent, and the institutional support is there. Do not get shaken out by boredom. Boredom is where the dividends compound. For new buyers, I need you to exercise some discipline. Wait. The risk reward isn't there to go all in right this second. The US Fed decision is a binary event. It could go either way. I would wait for a price pullback or clarity on the interest rate direction before deploying your cash. If the market dips on a hawkish Fed statement, that is your moment to buy these quality names we discussed today. Keep your cash ready, but keep your hands in your pockets for just a few more days. This is a market for the patient, not the frantic. If you found this deep dive valuable, if you want this level of analysis delivered straight to your inbox before the market even opens, consider becoming a free or paid subscriber to the Investing Iguana Substack. We go deeper into the numbers, we look at the technical charts, and we track the portfolio performance in real time. You'll be in good company. The Investing Iguana has now hit over 1.3 million reads with 65,000 likes across our platforms. We're also thrilled to welcome our growing community of over 30 YouTube Premium subscribers and 19 paid Substack members who make this in-depth independent research possible. You guys are the reason we can keep the lights on and keep the data flowing. Thanks for watching. Stay safe in the markets, do your own due diligence, and I'll see you in the next analysis.